This is quite dramatic in terms of what we've seen happen in the fixed income market. And that's certainly what I think is driving the bank stocks at the moment.
What are your expectations then in terms of the banking industry, which we've just been discussing here, is nothing like it was 12 years ago. But nonetheless, just this move overall, what are the implications?
So here's what it is. We haven't changed any estimates for the current environment yet because we wouldn't know what to change them to. So what we've done is we've picked two scenarios that we've modeled out. The first scenario is where we see 3 rate cuts, of which we've already gotten 2. So we've gotten 50 of the 75 basis points and a 1-year Treasury, 1% 10-year Treasury. We've already traded through that. Our second scenario was 5 rate increases, where you get basically the Fed funds rate down 0 to 25 basis points and a 50 basis point 10-year. If that condition persists into next year, we have modeled we would be cutting bank estimates by 27%. Now, the stocks are down over 20% already this year, so the market is already taking a lot of that into account. And it's precisely about what can these banks earn if interest rates head towards 0 and the yield curve is flat.
You think there's increasing likelihood of recession being also priced into the bank stocks at this point?
Well, in that second scenario, we do also have a recession scenario in the second half of the year. But I'm going to very much agree with what David said earlier, which is that Dodd-Frank, the good news of Dodd-Frank is the industry has a tremendous amount of liquidity, tremendous amount of capital, and we're starting from a point where essentially non-performing loans are 0 in the industry right now. So this is not a banking crisis. And then I also think a lot, and this is more severe than what we saw last August, but last August, when the last time the bank stocks rolled over like this, all the talk was about negative rates. And I know that the German bond's gone to a record level of negative rates. That would be a highly problematic situation for the U.S. banking industry if that happened, because the industry was not built for negative rates. So I think that investors want to know how far this is going to go.
Yeah, well, what do you think? We're a lot closer to negative rates than we've ever been. Is it a real possibility in your mind that we might get there?
My opinion is I read that employment report, and I think back to where we were weeks ago before the virus showed up, and the U.S. economy actually looked like it was picking up steam. I also read all these reports about prior times when this happened, and the word temporary keeps coming up. And I did listen carefully to your interview with Larry. And the reality is my instincts is that there's certainly, in addition to the personal cost, there will certainly be an economic cost of this virus. But the foundation of the U.S. economy is still really good. The U.S. banking system is still the best banking system in the world. And I think changing the parameters around that would have big implications. So if we can get back to a point that is reasonably similar to where we were 8 weeks ago, I think we can get through this.